Hi everybody, welcome to Talk About Houses. I'm Todd.
I'm Oana.
So yesterday we did the video where Warren Buffett was appeared on TV 9 years ago, and Alan, who watches the vlog, made a comment and said, "Hey, why don't you do a video about affordability and how it's changed since interest rates have changed and everything?" So we talked about it today, and we talked about trying to put something together simple to make it understandable and explainable to average people. Okay, so what we did is we're going to start with an example. Okay, so right here on the screen, you're going to see an example of a home purchase in 2011, which was 10 years ago, $200,000 purchase price. Interest rate at the time, about 4.75%. Your monthly payment, principal and interest, would have been $1,043. Your annual payment would have been $12,516, and at the time, the median income in the U.S. was about $40,000. So your percent of your income is 31.3%. So that's pretty reasonable. A lot of banks used to have like two different rates. They were 28, 35. It was pre and post and all this other, all your debt or based on the house alone. So 31.3% is kind of a reasonable, especially in the lower end. It's actually a lot less in the higher end because super high income people don't buy like $10 million houses. They usually just buy like a little bit nicer houses, right? Okay, so before we go into the numbers, let's talk about something called ceteris paribus. It's an economic term, and what it means is, you've heard it, is all other things remaining equal. And what that means is when you compare two things, you have to hold everything else equal, or sometimes the comparison changes, right? So we're actually that's not what we're gonna do. We're not gonna hold things equal, right? Because what are some things that have changed over the last 10 years?
So home prices have gone up.
Okay, home prices are higher.
Interest rates have gone down.
Interest rates have gone down. Now that's a big one, right?
Right.
Because when you buy a mortgage, explain to them what percentage of your monthly payment is interest expense and what percentage is principal reduction.
So, on a typical mortgage, let's say that your mortgage is $100,000, very little of your monthly payment. So let's say that your monthly payment is $1,000. Very little of that $1,000 actually goes towards principal. Most of it goes toward interest, particularly at the beginning of the loan.
Yeah.
Because remember, it's amortized over 30 years. So the beginning of the loan, it's only a few dollars that goes that. So let's say it's maybe $70 that goes toward principal, and the rest is going to be interest. So the lower your interest rate, the better off you are, obviously, because more of it's going to be going to principal, and it's going to allow you to purchase actually more of a home.
Yeah, so if this is the amount of your purchase, your mortgage, this is principal reduction down here. Very little. It's mostly interest, right? Your very last payment. That's the highest amount. That's like almost all principal, very little interest. And then when you amortize over 30 years, you can see how it changes, right? And there's calculators online. You can go look at that and play with that. So interest rates have changed. If you look historically, they've actually been coming down for about 40 years. 40 years ago, interest rates were 16%. And then maybe 20 years ago, they're about 8%, and then 4.5%, and now they're much lower, right?
Right.
Okay, let's talk about wages.
Right, so wages have gone up. I know that there's a big debate about stagnating wages. I know there's a big debate about wages versus inflation, that sort of thing. But look, the bottom line is wages have gone up over the past 10 years, which is the period of time that we're looking at. And so, of course, wages have gone up, interest rates have gone down, and yes, home prices have gone up. But where does that leave us regarding affordability of housing?
Okay, so keep another thing in mind, that we have two things happening at the same time. We have wages going up. So you could call it inflation. Some of it is inflationary, but some of it is actually better jobs, meaning as the economy gets rid of lower income, minimum wage jobs, they tend to get replaced by higher paying jobs. So for example, you go into the grocery store and you go to the checkout. It's a self-checkout. And people always get really upset. And they say, boy, I will never use the self-checkout because I'm taking somebody else's job. Well, not really, because some person would just scan all your stuff and you would pay them, and right? But really, if you think about it, how many jobs are created by making all of those machines, right? Mm-hmm. Engineers, designers, programmers, technicians that have to maintain it, and the stores tend to have people standing there helping, to assist scan things, or if you have coupons or whatever and you need help. So we tend to replace lower paying jobs with higher paying jobs. So that's another factor. We also have the consumer price index, which changes, and everything doesn't change at the same rate, right?
Correct.
We'll do a whole other video on the economics of housing and all that, but we just want to talk about specifically affordability, not the full economics and how they fit into the broader earnings. I am qualified to talk about that, being an MBA. We did study this in MBA school a long time ago. Okay, so we have home prices have gone up, we have interest rates have gone down, but incomes have gone up. So now what we're going to do is we're going to go back and we're going to put up this new slide and we're going to compare everything. Okay, so on the left column, those are the original numbers we talked about, 2011, percent of your income, 31.3%. So 2021, now the home is doubled, it's 400,000, but interest rates are much, much lower. A friend of mine just refied at like 1.85. You can get 2% interest rates, so we use that number. That may not be what you personally get or what you got recently, but we're just doing this to show the monthly payment on that $400,000 house is $1,478. It is more than the monthly payment on the $200,000 house was, a little bit more. The annual amount of that payment is $17,736, but incomes have risen.
Right.
So the average person that was making $40,000 now is making $52,000. So they're making $12,000 more. And when you take the percent of income, it's 34%. So it's higher, but it's not ridiculously higher. And so what do you think about that?
Well, I think this illustrates the point that the affordability hasn't changed substantially.
Okay.
And obviously there are lots of variables that we're not including here, but I think it does illustrate the point that the affordability is pretty similar to the way it was 10 years ago. So the argument that homes are substantially out of people's buying capacity is probably not as widespread as maybe the news media would like us to believe. Because let's face it, this does illustrate what really is going on in the marketplace. There have been other savings in the marketplace. Of course, we're able to work from home, and maybe that cuts down on other expenses that we have, like vehicles or clothing or childcare and that sort of thing. And arguments can be made that the costs of those have risen. So there are a lot of variables to consider. But when we're just looking at just flat out, look, home price to home price, interest rate to interest rate, income to income, that 3% is probably pretty manageable.
The other thing that that's not shown here that is very likely happening is the change of the people who are buying the houses, meaning that their relative wealth or income. So because of hedge funds coming in and buying, because of younger people with now much higher incomes. So this is this weird thing that's happening where these younger people who are in their 20s, late 20s, who have gone to college, they're designers or they're software engineers or people of that nature. They're in professional jobs. They're making far more money than their peers made 10 years ago because the tech and the higher paying jobs are now, the younger people are be attracted to those, even airline pilots, right? The people getting into aviation now are making far more money than people 20 years ago getting into aviation made the same age. So you have this new class of wealth being created in young generations. And traditionally what happened was the older generations had all the wealth, but then they weren't always buying houses. They were just sitting on wealth. Now you have this new generation of people with wealth. And the other thing you have here is, remember, you have hedge funds coming in and buying, and they're sucking up inventory, and they're creating more of a renter class. So now this specific example here, you may actually say, well, but that 52,000, the people buying are making far over 52,000. They're making 70 or 80,000 a year. So actually their affordability is even better, and they're more incentivized to buy a house than somebody 10 years ago who, just worked in a medium skilled type, medium education position.
Right, and there are a couple other things to consider because, and these are more social things, but I think that they're very important to keep in mind. We are talking about a generation now that is marrying later. They are having children later, so they are accumulating more wealth on the front end of their lives than maybe we did when we were getting started. Because remember, previous generations would get out of school, get married, and have some kids. This generation isn't doing that. They're getting out of school and they're making money, and they're making pretty decent money. And if they are coupling up, they're coupling up with somebody in a similar situation. They're not having kids right away, so their wealth is accumulating much faster than previous generations. And I think this is something that really hasn't been looked at very much. But I think it is definitely evident when we're looking at what's happening with housing. Remember, this is also the generation that maybe stayed in their parents' basement a little bit longer and that sort of thing. So they've had the opportunity to have low expenses and the opportunity to accumulate wealth before coming into the housing market. Now they're coming into the housing market, and again, they're coming in with more money than previous generations and less expenses. The argument can be made regarding student loans and that sort of thing, but I think that's a separate situation. Just looking at what's happening in the marketplace now, we are looking at these people who do have the money to purchase these houses, and the 3% that we're seeing difference between 10 years ago and today is not pricing them out of homes.
Yeah, that's an interesting point that Oana brings up. I graduated from high school in the early 80s, and the culture back then was when you graduated high school, you moved out. You didn't stay with your parents, you left. And it's different today. There was a stigma back then. People wanted more freedom, I guess. It was a lot more different. I think people grew up, the parents worked more. There was generally more angst and pressure at home, and people were ready to get out. So you had people that graduate and either go to college, live in dorms. Of course, it was more affordable back then than it is now. People would join the military. People would just, go find some roommates and go get a place. And, this group of people who are staying at home, they're going to college. They're tending to, not they all don't. They're tending to get a job and work, but still live with the parents and probably not pay rent or pay very little. But then by the time they say, hey, I'm going to go out and leave, they have a pretty big nest egg. So they're already out of college. They already have some money. They already have a nest egg, and they already have, they're still single. So they aren't married. They don't have a couple kids. I think a quarter of my college graduating class, age 21, 22, got married within the first year. A quarter. I would say that the other, at least another quarter, got married within about 3 years after. I think half of us were married after about 4 or 5 years. And today that would be extremely uncommon. Right. I think it's the median age of getting married is in the early 30s.
Right. I mean, look, our generation, by the time we were 25, we were already married and we had at least one kid. And that's not the case today.
Yeah. So because of that, the demographics has changed. It's changing significantly. I know a lot of you watch what's going on social media. You see these young people out there protesting capitalism, blah, blah, blah. But remember, on the other side of that, you have their peers, age-wise, who are not protesting capitalism. They're thriving in capitalism. And there's now more wealth being created. The wealth has to go somewhere. It's going into housing because that's a low-hanging fruit for them. A lot of them they're not wasteful, surprisingly. A lot of young people today have learned that you don't waste things. So a lot of them would not want to pay rent. They don't like the idea of paying rent. They would rather own the house and basically pay mortgage, that they would accumulate that wealth themselves. It's very interesting. I think there's a critical mass and enough of them, and they are the largest home buying generation. The millennials and Gen Zs, they're the largest home buying generation ever. The affordability comparatively, because of those two factors alone, you could look at all the other factors, but just interest rates being lower, and incomes being higher. So the prices have doubled in homes, right? By twice, let's say, in a decade, which is unheard of. It's really high appreciation. What's that, 7% appreciation? But guess what? They're still affordable.
Yes.
Any last comments?
Just kind of one last thought. One of the things that I've noticed, which has absolutely very much surprised me, is people of, in their late 20s, early 30s that are coming to Las Vegas from other markets that maybe homes are less affordable, and they're purchasing investment properties here and then still living in those less affordable areas. And I think that's a really interesting trend. They're looking at real estate as another investment asset class, much the same way that hedge funds are doing, because they've got a good job back wherever that is. They're investing their money in their 401k, which is investing their money in stocks and mutual funds and that sort of thing. And so they're looking for another investment vehicle, and they're using real estate as the other investment vehicle in a market that's more affordable for them as investors. And I think that's very unusual. So they are tenants where they are, but they've got real estate in another market that they can afford.
Yeah, and here's a perfect example. You work in the Bay Area, maybe software engineer, big name company, make a ton of money, have a huge 401k, have stock, but you can't really buy an investment property. Probably can't buy a house there, but you can't buy investment property either. So what are you trying to do? You're trying to diversify, and you have all this money, and you don't want to put it on the stock market, so you go to another market and buy an investment house, right? I mean, think about this. Most people are not buying their first house as an investment house. Most people, their first house is the house they buy, they live in. And then at some point down the road, that becomes an investment house, or some other house that they find and buy becomes an investment house. I think that's an interesting demographic change, and I think that as long as the future building does not accelerate dramatically, which there's no sign right now that it's going to, I think this is an interesting trend that could continue. Real estate is the largest asset class, period, end of story. It's, doesn't matter how much Elon Musk is worth or all the stocks in the stock market combined. Real estate in the US is the largest asset class. Worldwide, guess what? It's still the largest asset class. I don't know that anything yet is going to overtake it. So,
look, we all have to live somewhere, people.
Yeah, we have to live somewhere. Anyway, so just again, Alan, thank you for the suggestion of making this video about housing affordability. If any of you have other suggestions about videos we should make or questions you have, just put them in the comments. We read every single comment. We respond to most of them. And then we'll, if we think it's a good idea, we'll make the video. And if we already made it, we'll just send a link and say, hey, we already made this video.
Absolutely. So in the meantime, please like the video, hit the notification bell, share it with your friends, and leave us notes. We love your comments. See you on the next video. Bye.
Bye.